The deduction. The deduction, just by background, is based on all of these factors. The value of the property contributed, the life of the annuitants, whoever they happen to be, not the life of the donor, the life of the annuitants, because that's the life expectancy of payments are going to go out. Annuity rate and the frequency of payments. So if they're being paid quarterly, semi-annual, annual, there's an adjustment factor. And if you look at the illustration from Crescendo that I gave you, in the back, right on page 4, or sorry, starting on page 3 to 4 explains to you the computation. Okay? And you can see it's a rather long complication, and that's why you buy the software. Okay? The software that I use is Crescendo Pro, which is what this is. All right. I like it because I am a tax nerd, and they're very specific, and they provide like all the little details down to the penny as to what is paid. Some people like PG Calc. PG Calc does a nice thing, but what they also do is they have little stick figures, or maybe so their illustrations. When you look at a cash flow thing like this, it shows the value of the gift, the annuity payments back, and what passes on to charity. Okay. They have these little stick figures, and it helps people understand it, but I want precise. Not saying that PG Calc is not precise, I just like Crescendo Pro the way it works better. But that software is critical when you're doing these types of things, because if you do a long-term calculation, they take about 20 to 25 minutes to do each, if you have all the materials available to you. I can burn these off in about a minute, okay, and do all sorts of combinations and stuff using the software. So it's well worth the investment if you're going to do a gift annuities. And then a comment about gift acknowledgments. Everybody knows the whole thing. You give a gift of more than $250, you have to say, no goods or services were provided in exchange for this gift. What the tax law requires here is that you say, other than the gift annuity payments you are to receive, no other goods or services were provided in exchange for this gift. That has to be in your gift acknowledgment to the donor, because they have received something. They're receiving that promise of a future payment. Okay? So you have to disclose that, and then the valuation is what they end up being able to deduct. But if you don't put that in your language, you got a problem. So let's talk a couple planning opportunities. This is the typical one. The donor, like our farmer, wants to give something to support the charity, but still needs the income stream back. That's the typical thing. All right? That's where most people do these. I mentioned maturing CDs. We had a donor who actually lived in a retirement community, who every year she had laddered CDs. They would come due, they were like $10,000 a year. Every year she'd get these. And to re-up, she was getting like 1.5%. She wanted to support the facility that she was at, so which happened to have an endowment fund with us. So what she did is each year she would get a gift annuity. And she did laddered gift annuities after that. Got an immediate tax deduction, and we were paying her 7.5% interest. Win-win. I mean, if she was getting a higher income stream to live on, supporting her charity plus getting an immediate tax deduction. It was a great thing. Okay? She had to appreciate the fact that, she was a general creditor of us and things of that nature, but, we're kind of big now. So that helps with stability. Other ones. How about for planned retirement? I had an old client who was a doctor who every quarter would figure out what his profit loss statement was, didn't want to set up a SEP or any sort of other retirement plan. So what he would do is that he would set up a gift annuity, all of them tailored to start paying when he was going to retire. So they were all deferred for 65. So look at my profits, here's what I have left over, buy a gift annuity for the local charity. Next quarter, profits, here's what I have left for retirement, buy a gift annuity. Immediate tax deduction against his high income, and he had this deferred income stream coming to him in the future, which was partially tax-free, partially capital gains tax, the rest ordinary income, IRA, all income, right? You can also do this to add to IRA planning where you hit the maximum on your IRA plans, okay? That was an example of the pension plans with the doctor. I mean, it just worked out really, really well for him, and I think when I left, he had about 36 gift annuities all structured to pay off when he turned 65. So, not a bad way. Gift for household employees. You got a household employee that's been with you for a long, long time, and you would also like to provide them with some sort of stream in the future, or when you die. Okay, you can do a gift annuity that's payable to them or them and their spouse. So that's another. So these are little kind of interesting planning opportunities. I actually have 2 of these right now where it's for the household employee, long-term household employee. Okay, one of which is established when the person passes away. At that point in time, they're going to be looking for a job. So the family want to give them something to benefit from that. Okay? You again, you have to worry about gift and generation skipping taxes. One other note from a tax law standpoint is when you establish a gift annuity that's not for the benefit of you and your spouse, any appreciation in the asset at the time that you establish a gift annuity is immediately recognized as capital gain. So the basis becomes 100%, which means the recipient will get more tax-free payments as the payments are due, but you have to have reportable tax capital gain at that time. So a lot of times you'll do this with cash, or you do it with other people, unless you can recognize the gain. Okay with it, remembering that you're going to get a charitable deduction that might offset part of the gain. So you have to go through the mechanics. Okay? Estate planning. At death. You can do gift annuities at death. You can do charitable remainder trust at death. You can do charitable leave trust at death. Why not a gift annuity at death? Okay? Why, in this case, it might be that the person that's setting up the estate plan doesn't want it to encumber the family on having to do separate tax returns every year and all those type of things, or they want to do something modest. Maybe they want to do a $100,000 gift annuity, and that's just not practical to do through a charitable remainder trust. So instead, do a gift annuity. And there's language that you put in there to make sure that it's all qualified under the current tax code at that time and all, but you can do these. We have one family that's doing this, and it's 8 figures of worth of gift annuity for that. Okay, so they can be small, big. Okay. Nursing home resident. This was a kind of a cool one. We had someone that wanted to actually benefit a nursing home, and they were under conservatorship. A lot of people don't know this, but conservators under the probate code are authorized to make charitable gifts on behalf of the ward if they think it's in the best interest of the ward. Okay? And they've taken into account everything else. And I believe there's a maximum amount that you can give away, if I'm correct. It's 20%? I think it's 20%. 20% of their income a year, the conservator can do maybe 15, if I don't hold this right. They can give without having to get any probate court approval. You can go over 20% with the court's blessing. So we did gift annuity. I actually did this one time, and it was a lot of money. And I called the attorney and said, 20%, remember, 20%. And they said, oh, don't worry, lots of income. We're under the threshold. But you can do this without even having to go to court. And it's a way to provide another diversified income stream back to the ward and still support the charitable organization. And we did this, in this case, to make sure that the woman qualified for ongoing continuation of care at that place. So it actually benefited her and the organization so that she could continue the income qualification. Think a little bit out of the box sometimes when you come up with some really good things. So let's talk about some administrative concerns. We all think gift annuities are wonderful. Our donors are going to think that they're wonderful. This is kind of growing the fertile garden for these watermelons and strawberries to blossom. All right? Capacity. Does your staff know anything about gift annuities to be able to go out and market these? They need to go through training. I would suggest that Crescendo Interactive, makers of the software, has some really great programs for this. You can sign up if you want. You can go out to California, but they sometimes go to Washington, D.C., Chicago, and stuff. They used to never come west of Chicago, or east of Chicago. We were the first group that we forced them. We said, under Touch the Future, we actually had a training. We said, if you come to training, we'll have 20 some odd people there to train, and we're going to let them buy whatever software they want. We're going to give them a grant for that. Boy, did they come. But now that I see that they go to Washington, D.C. and things of that nature. So I again, a big fan of Crescendo, but there's other things. You go to plan giving, national conference, things of that nature. Legal counsel. Do you have competent counsel that can do the contracts? We have a standard contract with fill in the blank things that I'm pre-approved to use. The disclosure statement, that long thing that you have to prevent, it doesn't have to be real long, but do you have a disclosure statement that qualifies under the antitrust rules that we talked about earlier? That has to be sent out every time you do a gift annuity. Who's going to do that for you? State registration, extremely important. Okay, one of the things that you have to decide is where are you going to offer gift annuities, okay? Michigan is pretty good about this. Michigan basically says that as long as you are not making this a substantial part of your business, undefined, a substantial part of your business as a charity, you can offer gift annuities that are not subject to Michigan securities or insurance regulation, and there's no reserve requirements or anything like that. You are to manage that appropriately, okay? Other states are extremely rigid about gift annuity registration and the reserves of them. For example, California. If you issue a gift annuity in California and it's deferred, we did this one time, the reserves that we were required and mandated to set aside for that deferred gift annuity were 120% of the value of the gift that we received. Okay? Now, I don't know what the tables work out now, but I'm just giving that as an example. It can be really tough to do in certain states because of the reserve mandatory requirements that they have and what you have to do as far as additional disclosures and things of that nature. So before you just start issuing gift annuities to all of your supporters that are living, or your clients that are living in different states, you need to check into this. Florida is also tough. New York is tough. For obvious reasons, you can start thinking of the states that are doing it. But you can also usually work through intermediaries. So for example, what we ended up doing with the one in California is my friends at the California Community Foundation in Los Angeles have an annuity program where they will issue charitable gift annuities in California for charities in any part of the country. And they have policies as to how they do that, but you can work through them for an annuitant there, and then they worry about the reserve requirements, they worry about the payments and all those type of things, as opposed to you having to do it. Okay? Our policy is Michigan, everybody else on a case-by-case basis. I'll look at it and decide what we have to do, whether or not it makes sense. Okay? So keep that in mind, and that's why conflict counsel is good. The American Council on Gift Annuities website also has a list of all the registrations for all the different states. So it's a good resource. Investments. Another big thing as far as trying to manage your gift annuity program appropriately is what are you going to do with this while you're making all these payments? How are you going to invest this to make sure those payment streams are going through, that that you're not going to be on the front page of the free press instead of miss the payment? So how are you going to manage and invest those reserves? Again, the ACGA recommends or looks at a model portfolio. You can kind of use that as a guide. But that is something you need to consider is how you're going to manage that. And then reinsurance. Okay, you can actually go out and use part of the proceeds of this arrangement to buy a commercial annuity contract to make the payments back to the donor. Okay, that's allowed. That's an investment decision by the charity. Here's the tax trap. Make sure it's a discretionary investment decision by the charity and not an obligation under the contract. If the gift annuity contract says you will reinsure, their tax deduction is now limited to the difference in what they gave you and the value of the commercial insurance. If it's 90% of the gift and they thought they were going to get a 26% tax deduction, they will only get the 10% deduction. Because in essence, they're using you as an intermediary to buy a commercial annuity. So what you do is you put in the discretion of the charity to go out about reinsurance. I will tell you that we look at reinsurance on all of ours on an annual basis and decide which ones we should reinsure or not. So far, we've not reinsured any of them because our investment portfolio is doing so well that we actually do better than any projections on the reinsurance. So we've not done it. And a really good friend of mine who is an expert, I'm going to mention in a minute, on this stuff, usually says that you don't typically reinsure the entire value. You should just, if you're going to use reinsurance, use it as a hedging thing and do about 50% of it. So that way, you have some sort of positive flow there, but you still have to come out of investments with the rest of it.